Hello, everyone. On today's edition of the Final Bar on a Friday afternoon, we're going to wrap up the week. We're going to recap the short-term markets, but the Wrap the Week segment is where we take a step back, really think about how the markets evolved heading into year-end, heading into this holiday stretch. We're going to open the Final Bar mailbag, answer some questions about the chart pack setup, about microcap stocks, about how to set up some charts. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar on a quite rainy Friday afternoon here in Redmond, Washington at StockCharts headquarters. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Thanks so much for joining us every weekday for the Final Bar. The goal here with this show is to take a step back, look at what's happened in the short-term market environment, connect it to the longer-term trends, and make sure we're on the right side of the overall trends, really measure the momentum and how it's evolving over time. So today we have another continuation of the rally, another gap higher, another follow-through day to the upside, sort of continuing to trip higher and higher leading into the next couple weeks. Sort of the holiday weeks tend to be lighter volume, tend to overall finish stronger relative than weaker. But a lot of themes to unpack, and a lot of stocks. The real challenges we're going to talk about today are these stocks that are extended and potentially becoming overextended, and that's one of the really key themes I think we're going to hit on a number of times, looking at charts like the XLV versus Apple versus others. So a lot of themes to unpack. I did want to remind you about the Market Vision 2020 conference that's coming up on January 4th of next year. If you go to the earningsbeats.com website, you'll see a link to the Market Vision 2020 event, and you can sign up for the newsletter, which will give you all the little mini events leading up to the big conference. And it's going to feature a lot of my fellow StockCharts contributors like Tom Boley and Greg Schnell, Julius DeKempener, and featuring John Murphy, a longtime StockCharts.com expert, sharing his insights on the market. So you're not going to want to miss the event. Check it out if you haven't looked at it so far. So let's get to the markets, talk about a market recap. So, the question on everyone's mind as we have all the headline activity, thinking about elections, thinking about U.S.-China trade, thinking about the Fed and so forth, is just the price itself. What is the price doing? And as we've talked about many times on the show, right, the price is the best read on the economy. It's the best read on the markets and on investor psychology. And the trend continues to persist in a positive direction, right? So again, Charles Dow says an uptrend is a pattern of higher highs and higher lows. And as long as that trend continues, you have to think that the market's going to continue. Trends tend to persist. A couple things I will tell you about this. Number one of my, John Mendelson, who was one of my mentors, used to enjoy getting his research in my Fidelity days. He would say, I like trends that I don't need my glasses to see. And if I took off my glasses right now, I would still have a pretty clear uptrend looking at the charts right now, with most charts going up and to the right. It's very difficult to find charts that look relatively weak at the moment. Just overall, the trend has been positive. So what does that mean for us going into the end of the year? So at this point, when we're at all-time highs and we continue to push higher, again, you have to be in sort of trend following mode, because if you look left on the chart, there's no real measurement. There's no real way to look at where we've been and see where we're at relative to those key measures, which is usually what you want to do from a technical perspective. There are a lot of methodologies that allow us to try and anticipate when a trend is going to be exhausted. And it's things like Elliott wave analysis, Gann analysis, even the DeMark indicators. If you look at Rick Bensinger's show, all of those try to anticipate trend exhaustion. I tend to be more in trend following mode. And if you work as an institutional investor, you usually have to be a trend follower to do well as a large money management firm. And so I tend to think the trend is going to continue until it doesn't. So you're looking for signs of exhaustion, but you need some sort of validation, some sort of follow through to the downside. We have not seen anything like that yet in this market. Now, one of the interesting themes looking at every day for the last week, if we look at Monday, Tuesday, Wednesday, relatively flat sessions. This is after Friday was a nice jump up, if you remember. But the first 3 days of the week, pretty choppy, and the last 30 minutes had some distribution in there. Yesterday was a bit of an outlier. We really rallied, and especially into the close, we turned higher. And the last 30 minutes were fairly positive. Here we actually have back to that that pattern that we've seen so many times, which is selling off in the last 30 to 60 minutes. And again, broadly speaking, generalization there is that institutions taking profits, they're selling shares. But overall, listen, the trend persists higher, and overall you have to follow the primary trend. Don't fight the trend, and overall the trend remains relatively positive. Let's look at the member dashboard and just look at what sort of themes we can tease out today. Here's the last 2 days in the S&P. We can see the jump up, the distribution into the close, but overall finishing up about 0.5%, 0.49%, which is a nice follow through to the upside. Small caps notably were actually the weakest of the three. If you look at large and then mid, which was up a little more, small essentially flat. So while large and mega caps are actually up pretty good, small caps actually did not confirm it today. They actually were holding off a little weaker. Now that signal that we normally would expect from small caps has been a little bit kludgy, might be the word I would use. It's not been a sort of a great true measure, because in a time when the market's rallying in an extended bull market, when you'd expect small cap leadership, we haven't had this. Now, what this does tell you, and this is sort of a foreshadowing of our mailbag, I had a question on institutional selling, and this flight towards the large mega cap sort of safety trade versus small caps is actually pretty normal for this time of year. So we'll talk about that later when we open up the mailbag and answer some of your questions. On a sector basis, healthcare and technology, the two strongest, and industrials up third. Overall, earlier, not too long ago, about an hour ago, all of these were in the green. All 10, 11 sectors were in the positive. But now all of a sudden, half of them rotated back to the downside, with financials and real estate, which actually used to be part of financials, both down just over 0.33%. So sort of a rotation just today away from financials, away from consumer discretionary, into healthcare, into tech, really in the leading sectors, which also lines up with what we're going to talk about in terms of institutional positioning at year end. So some interesting themes to tease out there. In terms of short-term movements, just looking at the scooter rankings and some of the industry themes, interesting to see home construction, one of the top sectors, up almost 3% on a day that ended up about flat for the day, right? So you had a lot of upside in some of these home construction names. Lennar, which has obviously been very beaten down with a bullish engulfing pattern. And again, I'm looking at a bar chart here, but candle chart would look sort of similar. A big down day followed by a big up day, and the second day's range eclipses the first day's range. You had sort of a bullish engulfing pattern, which usually suggests short-term upside. D.R. Horton, not a bullish engulfing pattern, but also a bullish reversal pattern, the reversal candle pattern. So some interesting sort of moves in there. Cruise lines also is toward the top of the list, and look at how Norwegian Cruise Line has rotated really nicely. I love to highlight charts that have a period of distribution and then consolidation and then accumulation. And now the sign of accumulation is a higher low and then a break above the most recent swing high. And we sort of have this cup and handle like pattern as Norwegian Cruise Line's breaking higher. So an interesting potential early opportunity to get in on a stock like that. On the downside, we had a number of stocks gapping down on news events. So some interesting names to sort of go through here. NetApp is one that actually jumps out. I like looking at technology names that are starting to disagree. This has a bit of that bearish divergence, or the non-confirmation that we talked about earlier in the week with my guest Ramon, the Wyckoff expert. We talked about this bearish divergence of higher highs in price, weaker peaks in the RSI, and NetApp actually starting to follow through potentially after that sort of divergence. So some very interesting themes that sort of came out today. And again, the sell-off into the close is kind of interesting. Also, the laggardship of small cap stocks is another thing we're going to get to in a little bit. But let's go to our next segment, which is Wrap the Week. Every Friday, what we like to do is take a step back, look at the big picture, think about how the market has evolved week to week, and sort of look at some longer term trends. So I'm going to start at the Mindful Investor chart list. Then we're going to go to some of the scooter reports to see how things have changed week to week. If you missed it earlier in the week, we actually just added this a couple days ago. If you go to the Mindful Investor chart list, and if you can't get to it, just go to my blog, go to the articles section, look for the Mindful Investor. You'll see my name, and you'll see at the very top a link to this chart list. You can click Save to Chart List. It'll put it right into your own login, so you can take these, make them your own, make changes to them, make annotations, do whatever you like. But my charts are your charts, friends. So let's go through some of these big picture trends. So starting with the long-term picture of the S&P 500. And again, I don't mean to beat a dead horse with this, but the primary trend is positive. So all the speculation about what might happen next year and all of that is secondary to the fact that the trend is positive. And we know that from a number of reasons. higher highs in price, higher lows in price, upward sloping moving averages. This is the PPO based on the long-term exponential averages that I use, the 21 and 34 week, very, very positive. And in the more short-term side, this is a weekly PPO using the traditional settings, the MACD or PPO settings, also bullish as of mid-October. So firing on all cylinders. Overall, the trend is positive until proven guilty. And we saw that confirmed with breadth. I think in the last couple of weeks, one of the big confirmations we've had of strength going into the year end is the fact that breadth has remained so positive, especially in mid caps and small caps. So even though small caps, flat a little bit today, overall the accumulation, the breadth on each of those cap tiers, very, very positive. Also a healthy number of new highs. So even in the last week, we don't have today's level updated just yet. I would assume this will jump up a little bit based on the fact that we gapped higher on the S&P and a lot of stocks are seeing new highs. But in the last week, we've had 10 to 20% of the S&P names hitting a new 52-week high every day. And that is not a small feat. That does not happen that often, especially the persistence of these new highs. It shows you a lot of stocks are going into it. Now, that's looking at the S&P, which is granted a pretty large mega cap sort of universe. The last one I want to talk about before we get to some of the scooter reports is looking at breadth relative to the 200-day and the 50-day moving average. This is one of the charts we referred to a lot recently. Thought it'd be good to take a step back here and think about the breadth for the S&P by this measure. So 80%, 4 of 5 stocks in the S&P 500 are above their 200-day moving averages, which on the surface sounds very positive, and I would totally agree. The challenge is when you look back, that's where it's been when the market's pulled back. Because if 80% of the stocks are above the 200-day, that is a huge swing, a huge momentum shift with so many stocks in a primary uptrend that usually tends to be unsustainable, right? That tends to be a point. Even though the primary trend could continue, it means we're pretty overheated because so many stocks have gone up so much and are so far above their 200-day moving averages. So, again, it might not happen immediately, but it's certainly telling you that we're at that point where we would near a potential top if this past pattern continues. Also interesting to see the percent of stocks above their 50-day. This had been in a stepwise motion lower. So as the market had gone higher, less and less S&P names were above their 50-day. So each time the S&P swung back above its 50-day moving average in pink, less and less stocks were actually mirroring that. They weren't quite getting above it. That has now changed. That pattern has broken. And now, again, you have almost 80% of the S&P stocks back above their 50-day. So you've really had a rotation back into the average stock. The average stock in the S&P is doing fairly well. So overall, the trend is positive by many measures. When we get to the mailbag section, we're going to talk about, maybe we'll hit on a theme here in a moment about some of the industry and sector themes. You know what? Let's go there. So we're going to shoot over to some sectors, and we're going to look at the XLV. So, the challenge that we have is the fact that so many stocks are up so much. And again, that's a good thing. That's probably what we want as equity investors. The challenge is, what does that mean when things become a little overheated? So I'm going to add RSI here to the chart of the XLV. And now what we're seeing is on a relative basis, healthcare has improved. Overall, been sort of a market performer, broke to new price highs, returns on a relative basis, improving. That's all positive. But if you look at the RSI in the bottom, we had this bearish divergence of higher highs in price, lower peaks in the RSI. And look how that emerged the first couple weeks in December. All of a sudden, look how this picture has changed. Now, as price has gone higher, that bearish divergence really wasn't confirmed. We actually broke that pattern and went back positive. The RSI is almost nearing the extreme overbought region when the RSI is above 80. And again, on average, what that tends to mean is the upside momentum is so strong, even though you'd have a little bit of a pullback, you'd expect at least one more leg up to digest all of that momentum. The momentum's so strong, the buying pressure is so strong, it's not just going to go straight down, most likely. You saw that back here at the end of November, where it was extremely overbought. We pulled back a little bit, but then continued at least one more leg higher. Now it potentially looks like that pattern's going to continue. That might be the strength we're looking for leading into year end. That would satisfy the seasonal tendencies of strength of sort of large cap stocks leading into the first of the year, and then could open the door to a potential correction in the first quarter. Obviously, is sort of what that might line up. Now, when you look at something like the XLV, you have to look one level down. So if we look at the drug index, you can see that parts of the healthcare sector are actually already extremely overbought. So the DRG, the pharmaceutical index, with an RSI well above 80. So again, what that means is the momentum is so strong, you'd probably expect a little bit of a pullback, but at least one more leg higher. So we might digest the gains, but overall still seems like a pretty decent place to be. Let's look very quickly here at these scooter reports. We're going to look at how some of these things have evolved. And what I like to do is look at industries, and I like to look at 1 week. And now I can see what has moved. What groups, what industries within the large cap space in the US have been up the most? And you can see there's a lot of real estate in here. We talked earlier this week about the emergence of real estate, the strength in a lot of real estate charts. 3 of my 5 sort of sleeper picks were all REITs because they just surfaced up. So holding and development, hotel and lodging, all up at the top here. You also have marine transportation, home improvement retailers, food products. So these are a number of different sectors that are actually represented here. And then multi-utilities, one of the better sectors this week. So some interesting, certainly more conservative names. I'm seeing distillers, I'm seeing tobacco, I'm seeing alcohol. Those don't tend to be, sort of long and strong. Those are more conservative places to park your assets. In terms of moving down, drug retailers you saw in here as one of the worst groups, and so that's something that's come down. But aerospace with the Boeing news and changes with the 737 MAX certainly has been affected. And mining stocks, so mining, steel, you have a lot of industrial sort of materials, basic materials types of groups that are down there. So again, we're just teasing the idea of these scooter reports and the industries. I would encourage you to look through there, click on one of these, actually look at the chart, look at some of the names that comprise those groups, and get familiar with what types of stocks have been moving, because I think on a week-to-week basis, it's a really logical time to try and make that analysis. We are going to take a quick commercial break. We're going to be back opening up the final bar mailbag, answering some of your questions from the last week. So we'll see you in 30 seconds. Hey guys, welcome back to the final bar. Thanks again for joining us every weekday here on StockCharts TV to wrap up today's price action connected to the long-term trends from a technical perspective. We want to open up the final bar mailbag. As you know, one of my favorite parts of this show is to answer your questions. You can get questions to us anytime by email, thefinalbar@stockcharts.com, or during the show at any point. Just put a question in the Q&A panel. We'll get to it as soon as we possibly can. We've gotten so many great questions, thoughtful questions relating to the stuff that we've shown on the air and some of our interview guests, and I want to answer a couple of those right now. Number one, as part of that Market Vision 220 event that's coming up in January, I actually did a webcast earlier this week with Tom Boley where I shared my morning coffee routine. I talked about how I look at charts and sort of the order as being so important. If you missed that, you can go to YouTube, search for David Keller routine, and hopefully that'll pop up pretty much at the top of the list. That's the webcast for this week. But if you go to your member dashboard, click on chart lists, go to the bottom. I have quite a few, sorry for that. But if you go to the very bottom in your login, you're going to see Manage Chart Packs. And if you click on that, you're going to see a list of chart packs. These are all ones that you can install. These are from some of my fellow StockCharts contributors. And the very new addition as of about 20 minutes ago, thank you to our development team, is my morning coffee routine chart pack. So if you click install, you can actually put my set of charts that I look at every morning. You can put them in your own login. You can put your own notations. You can tweak them, save them, adjust them, do whatever you want. If you do use those, I would encourage you to make it your own. You're welcome to steal mine to start, but evolve it, right? Start to adapt it. Things that aren't that important to you, get them away. Add things that are important to you over time. And the more you make it your own, the more you're going to stick with your own routine. So check out that chart pack if you haven't looked at it. Easy way to get some of the charts that I show on the screen here into your own login. And then again, any questions, shoot them my way. But thanks for the question on that event and asking for some of the charts. That's the way to do it. Just set up for everyone. The second question, and thanks for sending this in the chat room yesterday, was on microcap stocks. So I talk a lot about small, mid, and large, and the question was on microcap stocks and how that relates to what we've seen. So what do you make of the performance of microcap? So here is the IWC. This is the way I usually like to follow it. This is the microcap ETF, pretty liquid, good way to get exposure to that part of the market. If you look at the last year, it's actually been a relative dog. It's been a relative underperformer. So starting about a year ago, right about at the market bottom, had underperformed by 12, 13% on a relative basis as of the beginning of the fall here. But look at how it's just starting to improve, making a potentially a new 3-month high in relative strength. That's kind of interesting. It's broken above some resistance levels. You can see the lines that I've notated here around 92.50 was pretty key. Then broke above this resistance level from February and May. That was pretty impressive. Now breaking, and going to all-time highs, nearing 100, which tends to be a psychological level. This is what I think is most important beyond anything I just said. The RSI is extremely overbought. And again, with the chart of the XLV and with the drug index, we saw the same thing. This means that the momentum, the upside momentum has been so strong, you'd expect a little bit of a pullback, which is totally normal, but overall the primary trend is most likely going to continue higher. And that's what that tends to mean. The momentum's so strong. So what it suggests leading into year end, what would probably happen, again, if we follow the normal playbook, you'd expect a bit of weakness here because microcaps are relatively speculative and big institutions are not going to want to be parking there for the end of the quarter. They're going to want to lock in some more conservative blue chip type of positioning and stick with things that have worked. But then they will rotate and force back into more speculation like microcaps. And so you could potentially see that line up calendar-wise with what we might see here, right? A short-term pullback and then a resumption of the uptrend in January. That tends to happen with small and microcap names. So an interesting thing to look at. We saw that certainly here at the beginning of this year, where you saw microcaps outperform the first 6 weeks of the year before it rotated lower. So thanks for the question on microcaps. That's a really good question, and that's sort of my takeaway on it. Third question was on one of the charts that I've shown, looking at sentiment indicators. I've shown this chart here, or a version of this chart. This is looking at the AAII rankings, and it's using this really pretty histogram where it's coloring the bars green and red. They're kind of stacked on top of one of each other. This was an Arthur Hill trick. He showed me this. I thought it was beautiful. For certain things, it's a really good way to visualize bullish and bearish signals. So something like the AAII ratings, we have a bull and a bear read. It's perfect for that. Here's the trick to do it. There's an indicator called price up-down pair. You can see it listed under the indicators. Then it'll automatically put probably 2 tickers in here. Just put any 2 tickers separated by a comma. The first ticker will be going up in green. The second ticker will be going down in red. If you have some weird things that are, that might be different, it might look a little different than this, obviously, but this is generally how it's going to come out. And so anything like bull-bear sentiment where you have a positive and negative signal you want to look at, it's such a good way to visualize it. So that's the trick, price up-down pair. And again, thanks to Arthur Hill for most of the cool things that I've shown you are probably due to him or Greg Schnell or Tom Boley, Julius de Kempener. These are guys that have known the product and used it much more effectively than I have. The final question, and thanks again for all of these questions, was on positioning, institutional positioning. And I mentioned earlier this week at some point about institutions and when and how they sell, how they take profits, and just thinking about year end and what it means. So I will answer a couple. It was a beautifully phrased question, and thank you for taking some time putting it in there. But it was about supply, limited supply versus excess demand, and Roman Bogomazov earlier this week talked about that in particular. He talked about the limited supply, the excess demand, and what that means for stock. So what that essentially means is, especially in the larger names like this, seasonally, right? In terms of window dressing, what that tends to mean is at the end of the quarter, you take a snapshot of your portfolio and you have to report to clients what you hold. And so the big institutions usually will take off any huge, ridiculous bets, out of benchmark bets, out of character bets that are going to make their portfolio look like they're not doing what they're supposed to. And they're going to put it in line as much as possible with 2 things. Number 1, what their mandate is. And number 2, what has worked, because you want to show that you've been in the good stuff. So things that have worked really well, like healthcare and technology, most likely will see a bit of a boost because of institutions rotating there. And that's sort of that idea of excess demand. There's going to be demand for those large cap sectors that have worked. And so you'll probably see those continue to be a little bit stronger. You tend to see small cap weakness because people are sort of taking their foot off the accelerator, unwinding more speculative positions. So small micro caps don't tend to do as well because on general, that's where they'll take some of it off there. The question in particular was asking about the equal weighted S&P. And so I put a chart in here looking at equal weight versus the S&P. So this is the RSP, which is an equal weight S&P ETF, and the SPY, which is the normal cap weighted ETF. Now what you see is that this ratio is continuing lower, which sort of validates that, right? People are getting away from the lower end of the cap tier, the mid-cap part of the S&P, and rotating to the mega-cap stocks. That is pretty natural for this time of the year. But as you correctly pointed out, this trend has actually been in place for much of the year, right? And it sort of goes back to the FANG trade. Remember how everything's so concentrated and the big mega cap stocks are leading? That's sort of what this chart tells you has continued, even though it's not been that concentrated on 5 or 6 names. Overall, it's been the largest stocks in general that have tended to perform well. That's why small caps in general have been underperforming large caps. That's the chart here. That's why the equal weighted S&P has been underperforming. So overall, if the normal trend would continue, this would probably remain relatively muted until the new year. And then that's when these two charts, again, broadly speaking, tend to improve because people are putting their aggressive bets back on, getting back into small cap, getting back into mid cap names that might provide some potential upside in the first quarter. So thanks so much for all of those questions. Those are all questions directly from you guys in the last couple of days. Please keep them coming and we'll get to them anytime we can. We, however, need to wrap up today's show with a 3 in 3. So at the end of every show, 3 charts in 3 minutes. What are the ones you need to be familiar with? This is actually our last live broadcast of the year. So I wanted to hit with 3 charts that I think tell the story as to where we're at now. Telling the entire market story in 3 charts is a bit of a joke, but I'm going to do the best I can to hit on a couple themes that I think you want to know. Number 1, I think, is extremes in sentiment. People always talk about bull markets ending in a euphoric period. And if you look at the AAI ratings right now, I think you could argue that we're right about in the realm of where you could start to call it euphoric. We looked at this yesterday. This is one of the 3 in 3 yesterday, and I repeated it today to show 44% of respondents were bullish on the S&P for the next 6 months. Bullish on stocks, really, I think is the wording of it. That's the highest it's been since last October, which was a market top. Before that was June, which is a bit of a pullback, granted. And then before that, it was the really heavy move out of the beginning of 2018 before we had the nice drop at the end of January. So we're at the levels of extreme where we've been. That doesn't necessarily mean it's a sell signal, but it tells you we're hitting that euphoria. Now you look for some signs of exhaustion. Also, the spread from bull to bear, the difference between the green bar and the red bar is the highest it's been since all the way back here last June. So it's a very extreme reading. I think that euphoria going to year end is a key theme. And what concerns me is if and when we get a bit of a pullback, I think people will get very scared very quickly because we're so bulled up right now. The second chart for the 3 in 3 is the chart of Apple. This bearish divergence that you see on a chart of Apple, I don't like seeing that on one of the biggest names in the S&P 500, a widely owned stock that so many have exposure to. That non-confirmation, that bearish divergence between price and RSI doesn't tend to end well. That tends to end in more of a pullback. And again, I could see seasonally that ending into a bit of a pullback in January, but we'll have to see how the next couple weeks play out. But that's something I'd be looking for. The third chart in terms of the 3 in 3 is the opposite of that. Things like healthcare, things like technology, things like the pharmaceuticals index, things that actually are at or becoming extremely overbought. This is what tells you, or what would suggest, that potentially the euphoria still has some legs. Things have gone up so much, it's not just going to go straight down. You'll probably have some digestion of the gains. And if you think about what can happen is we could drift higher a little bit, satisfy the seasonal investors that expect some strength, but overall have plenty of room to come down and digest those gains. And again, we can pull back in a very meaningful way and still be in a primary uptrend for a lot of these stocks. And that's one of the themes that I think is going to plague a lot of investors, or definitely concern us going into the next year. Folks, that is our show, and that is a wrap for 2019. For the final bar, I want to thank you so much for joining us. This is a new show this fall, and the response has been overwhelmingly positive. We really appreciate it. Wanted to highlight a couple things for you. In the next 2 weeks, over the holidays, we're going to give the StockCharts TV family a chance to spend time with their families. We're going to have limited live programming, but there are going to be some really cool special programs you want to be aware of. Number 1, we have a 2019 influential market events segment we've put together. A lot of contributions from my fellow hosts, hosted by Grayson Rose here from StockCharts. That's coming up on December 26th. The week of December 30th, I'm going to be back sharing you my top 10 charts for 2019. So look for that on the schedule. We'll repeat that week. And then our 2020 market outlook, featuring some of the hosts from StockCharts TV, will be coming in mid-January. So keep your eyes peeled for that. We're also going to be sharing some of our special interviews we've done in New York done in Las Vegas, done in Minneapolis, and share with you some of the insights we've gotten from market experts over the last month or so. So a lot of very good programming, and we'll be back with you live on January 6th. Please keep your feedback coming. The final bar at StockCharts.com. Happy holidays from StockCharts. Have a good one.